Are you losing 15% of your TFSA dividends and you don't even know it? If you're holding US stocks in your tax-free savings account, Uncle Sam is taking a cut. But here's what most Canadian investors don't understand. That 15% tax might not matter at all if you're investing the right way. By the end of this video, you'll know exactly which U.S. investments belong in your TFSA and which ones are literally costing you thousands. Let's break it down.
All right, let's get right into it. So you've got a tax-free savings account, a TFSA. That's a great start. But, if you're just letting cash sit in there, you are seriously missing out on its true power. Today, we are going to dive into how to turn that TFSA into a real wealth-building engine by investing not just here in Canada, but in the US market too. But here's the big question. You could call it the million-dollar question, but maybe it's more like the 15% question. We all know the TFSA is tax-free here in Canada. But what actually happens when your money crosses the border? When you go to invest in the biggest stock market on the planet, does Uncle Sam play by our rules? Well, let's find out.
Okay, first things first. Before we can even start talking about what to invest in, we need to know the basic rules of the game. And according to the Government of Canada, the #1 rule you've got to understand is your contribution room.
So what is contribution room? Think of it as the total lifetime limit of what you can put into your TFSA. It starts building up the year you turn 18, and every single year the government gives you a new chunk of room. And here's the best part. If you don't use it, you don't lose it. It just keeps rolling over, adding up year after year. Let's make this real with an example. Let's follow this guy, Joe. In 2023, he turns 18, gets his first $6,500 of room, and he puts it all in. Simple. His remaining room is zero. But then, in 2024, a new $7,000 limit is added. Joe only contributes $2,000, which means he has $5,000 left over. So what happens in 2025? Well, that $5,000 carries forward and gets added to the new $7,000. And just like that, his total available room is now $12,000. See how that unused space can really snowball over time?
So, now that you know the rules, let's talk about the fun part. What can you actually hold inside your TFSA to put all that contribution room to work and start building some actual tax-free wealth?
For a lot of people, the easiest and smartest way to start is with an exchange-traded fund, or ETF. Just think of it like a basket that holds hundreds of different stocks. You buy one share of that ETF, and boom, you instantly own a tiny piece of every single company in that basket. It is diversification made incredibly simple.
And here's what that looks like in the real world. This is the breakdown for a big Canadian ETF called XIC. You can see right away it's loaded with financials, the big banks, and energy companies. Why is that? Well, because that's what the Canadian stock market is. When you buy this ETF, you're basically buying a cross-section of Canada's biggest companies. Now, you can get more specific than just buying the whole market. Here, we're looking at 3 different Canadian dividend ETFs, and you can see there's a trade-off. On the left, XIC gives you huge diversification, over 200 companies, for a rock-bottom fee. But look over on the right, XEI gives you a massive 5.4% dividend yield, but it's more focused and costs a little more to own. See, there's no single best choice here. It really depends on what you're after. Broad exposure, higher income. And of course, you're not just limited to ETFs. You can absolutely own individual stocks. If you're looking for long-term growth, you might look for companies that have a really strong, durable advantage. Take a company like MDA Space, a Canadian tech firm with a mind-blowing $4.8 billion backlog of orders. That signals some serious future revenue. Or a company like 5N+, which supplies critical materials for semiconductors, making it a key player in a massive global industry. Now, these are just a couple of examples of the kinds of growth companies you could hold.
Okay, so you've got your Canadian investments sorted, but real diversification means looking outside our own backyard. The US market is the biggest in the world, and it's just packed with opportunity. But, and this is a big but, when your TFSA money crosses that border, it runs into a bit of a snag. There's a catch you absolutely need to know about.
15%. This is the number. Go ahead and burn it into your brain because this number is the key to understanding everything about how your US investments work inside a TFSA.
This is what's called the US Withholding Tax. Basically, the IRS automatically takes a 15% cut of any dividend paid out by a US company before that money ever even gets to your account. But here's the most important part. I really want you to hear this. This tax is only on dividends. It does not touch your capital gains. So if you buy a US stock for $100 and sell it for $200, all of that profit is still completely tax-free inside your TFSA. For a stock with, say, a 2% dividend, this tax works out to just 0.3% of your investment each year. It's really not that much.
So is this 15% tax a deal breaker? You know, I love this quote from a user on Reddit who I think just nails it. They said, "Don't cut off your nose to spite your face over a pittance." And they're right. For most growth stocks, the dividends are so tiny that this tax might only be a few dollars a year. It's something you need to be aware of for sure, but it is not something to be afraid of.
So if it's not a deal breaker, then how do we handle it? How do we invest intelligently? Well, it's all about strategy. It really just comes down to using the right tool for the right job, or, in this case, the right account for the right job.
And right here, this is the big aha moment. This is the core strategy that savvy Canadian investors use. Just look at the difference. In your TFSA, the US government basically says, we don't know what that is, so they apply that 15% tax. But your RSSP? That's a completely different story. The US does recognize it as a proper retirement account. And because of a special tax treaty, US dividends paid to an RRSP are completely exempt from that tax. We're talking 0%.
So you might be wondering, why the special treatment for the RRSP? Well, it all comes down to the fine print in the Canada-US tax treaty. The treaty has specific language that classifies an RRSP as a pension trust, and that category is explicitly exempt from the tax. The TFSA, on the other hand, is a much newer account, and it just doesn't have that special classification in the treaty. That's it. That's the whole reason for the difference.
Okay, so with all these rules and treaties and exceptions, you might be sitting there thinking, you know, this sounds kind of complicated. Why should I even bother with the US market at all? And you know what? That's a totally fair question. So let's zoom out and look at the big picture for a second.
Now, if you look at the recent numbers, you might see some reason to pause. It's true, US economic growth has cooled off a little bit lately. This chart shows that GDP actually dipped slightly in early 2025, right after a really strong run.
But that is only half the story. Because despite that little slowdown, the foundation of the US economy, its job market, is still incredibly strong. The unemployment rate is stable, and it's hanging out near historic lows. So what this tells us isn't a story of weakness, but one of resilience. It's this deep, powerful economy that continues to be a global engine for innovation, offering investment opportunities that you just can't find anywhere else.
So there you have it. You know how your contribution room works. You have ideas for what to hold in your TFSA, and you know the key strategy for managing US stocks by using your RRSP for those high dividend payers. You have the rules of the road. So the only question left is your TFSA working its hardest for you? Are you ready to put it to work on the world's biggest stage? Thanks for tuning in.
So, there you have it. The complete breakdown of how to navigate U.S. investments in your TFSA without leaving money on the table. If you found this data valuable, do me a favor, hit that like button. It tells YouTube that Canadian investors need this type of content. And if you want daily breakdowns on global economic data, investment strategies, and wealth building for Canadians, hit subscribe and turn on that notification bell. Tomorrow, I'm releasing the Economic Freedom Index 2025. You'll discover which countries offer the best environment for your investment dollars. See you tomorrow.